Did you know that today's oil battle could shake the global economy and your wallet too? In May 2025, OPEC is deliberately flooding the market, pushing barrel prices down to levels that threaten the profitability of U.S. shale oil, with ripple effects on gas, food, and your daily expenses. Want to understand what's at stake, the risks involved, and most importantly, how to protect yourself and even profit from the situation? Don't forget to like, share, and subscribe, because your path to financial freedom starts right now. Context: the war for oil control. Setting the stage. The oil world is split between two giants: OPEC, Organization of Petroleum Exporting Countries, which includes countries like Saudi Arabia, the UAE, Iraq, and Russia, and the fast-growing U.S. shale oil sector, powered by fracking. OPEC controls a large share of global reserves and acts as a cartel, adjusting output to influence global prices. U.S. shale oil has surged thanks to fracking technology, dramatically shifting the global energy balance. This clash affects not only oil prices, but also global economic and geopolitical strategies. OPEC versus shale. OPEC has long managed global supply, tweaking production to maintain profitable price levels, a move that impacts investors, banks, and governments worldwide. Meanwhile, the U.S. shale boom has made the country self-sufficient and even a net exporter, reducing its reliance on foreign oil. Each shale well represents millions in tech and infrastructure investment, with quick turnaround cycles that react to market shifts. Analogy: think of a board game. OPEC controls the board, making the moves. But the U.S. came in with a wild card, shale, that changed the game. The U.S. played a wild card, forcing OPEC to rethink its strategy. Economically, this means new investments, a global tanker fleet, and volatile capital markets. Amid the uncertainty, governments and investors around the world are scrambling to reposition themselves while the game evolves fast. What's happening now? Recent developments. In May 2025, OPEC boosted output by 1.5 million barrels per day, increasing global supply and crashing prices, a calculated move to destabilize the market. This glut directly impacts producers relying on higher margins, especially in the U.S., and has introduced new uncertainties across the sector. International banks are already tightening credit for fracking projects due to the risk of prolonged low prices. Current numbers. Barrel prices are falling towards $60, well below the $65 to $70 range U.S. shale producers need to break even. That $5 to $10 gap translates into millions lost per oil field. Smaller companies are already cutting capex and laying off workers to preserve cash. The financial dominoes are already falling. Strategy spotlight. OPEC is weaponizing oil, flooding the market short-term to shake up U.S. investors and regain medium-term price control. If it works, the U.S. will need to rethink its energy goals and budgets, delaying expansion plans. Diplomatically, it's a strong message. OPEC still has power to counter emerging threats. The impact is global. Investors must closely watch balance sheets, inventory levels, and developments in the fracking sector. Why this battle matters. Why oil prices matter. Gasoline. In the U.S., a 10% drop in oil prices can mean gas prices falling 8 to 10%, a direct relief for consumers. Food. Fuel impacts transportation and farming supplies like fertilizers and pesticides. Oil prices shape supermarket inflation and global supply chains. Inflation. Lower energy costs ease inflation, but also cut tax revenues for oil-reliant countries. Financial market impact. Falling oil prices hurt energy company profits, dragging down indices like the S&P 500 and MSCI Energy. Investors rebalance portfolios, shifting capital to defensive sectors or renewables. ESG funds gain traction as big asset managers reduce exposure to traditional oil, redirecting global capital flows. Global examples. Countries like Germany and India still depend heavily on imported energy. Price pressure hits production costs and inflation hard. In the U.S., it's a double-edged sword. Consumers benefit, but shale jobs and investments take a hit. In Latin America, competition intensifies between state-run and private oil companies as energy dynamics shift. Risks involve break-even points. Shale needs $65 to $70 per barrel. Anything below jeopardizes reinvestment jobs and production capacity. OPEC Saudi Arabia needs around $90 to balance its budget. Russia needs about $77. Long term, this price war could lead to fiscal deficits, infrastructure cuts, and even social instability in exporting countries. Side effects: OPEC's low-price strategy reduces its own revenues. Governments may cut subsidies or change tax policy, affecting citizens. In the U.S. fracking sector, borrowing becomes harder as lenders tighten credit terms. Repeating this cycle may trigger a wave of mergers and force small players out of the market. Fast comparison: it's a survival match. Who can hold out longer, oil-rich governments or the U.S. private sector? Both are exposed. OPEC needs steady income, while the U.S. relies on a healthy private industry. A long standoff could mean budget strain in Riyadh or bankruptcies in Midland, Texas. The outcome is uncertain. This could be a decades-long war with moments of intensity and pause. Historical comparison: 2014 as a case study. OPEC slashed prices in 2014, sending oil from $100 to $40 to $50, hitting the shale industry hard. U.S. investors pulled funding. Some fracking companies went bankrupt, and unemployment rose in regions like Texas. It was a shale winter, impacting airlines, logistics, and even local water resources. Today, a different picture. Shale producers have become more efficient. Better drilling, water reuse, and lower operating costs. Larger, consolidated firms now have better credit access and hedging strategies. Still, there's a limit. At $60 a barrel, companies hold off on launching new fields, slowing future growth. Lessons learned: resilience has improved, but OPEC is paying a price too. 2014 showed that a global supply shock hits more than just energy. The current standoff is between experienced opponents. This time it's faster, more technical, and more expensive. The geopolitics of oil as a weapon. Russia cut gas supplies to Europe in 2022, proving energy can be a geopolitical tool. If prices stay low, producers might impose selective restrictions to force price corrections. This fuels debates on energy security, renewables, and diversification. Energy vulnerability: the renewable transition is slow. Dependence on oil remains high, especially in heavy transport and industry. Countries without reserves, like Japan and South Korea, are especially vulnerable to supply shocks. This boosts efforts around strategic reserves, bilateral agreements, and international investments in clean energy. Real-world examples: Brazil feels the impact too. Imported fertilizer costs, diesel for transport, toll prices, all fluctuate with oil. Argentina had to renegotiate energy contracts during price and currency shocks. In the Middle East, Saudi Arabia and the UAE are pushing for economic diversification, a sign they want to avoid past boom-bust cycles. How it affects you and investors: shale companies at risk. Stocks like Exxon, Chevron, Pioneer Natural Resources, Devon, all react to oil price shifts. A prolonged dip could mean earnings and dividend cuts, threatening valuations and investor confidence. Smaller operators are already hurting. If prices stay low, even shale giants may rethink future projects. U.S. economy: regional investment cuts, job losses in fracking zones, lower tax revenues, all weighs on GDP. Oil-producing states may face budget crises and public service cuts. States like Texas, Oklahoma, and North Dakota are under pressure to diversify their economies. Opportunity for investors: if prices fall too far, it could trigger a turning point, paving the way for mergers and acquisitions. ESG and clean energy ETFs stand out, along with strong traditional energy ETFs. Discounted stocks may offer great entry points, but require careful analysis of volume, capital flows, and macro signals. Investor recommendations: conservative strategies. Passive ETFs, e.g. VTI, VT, XLE broad diversification, reduces sector-specific risk. DCA, dollar cost averaging buying, regularly lowers timing risk and helps reduce emotional decisions. Ideal for long-term growth. Takes advantage of dips and rides recovery cycles. Active investors: follow EIA and OPEC data. Weekly updates on output and inventory levels. Spot market shifts. Taliban disruptions or tanker strikes can trigger big moves. Act fast, but manage your exposure. Energy markets are volatile and driven by headlines. Risk versus reward. Only invest what you're prepared to lose. Volatility remains high. Use 15 to 20% stop losses. Position management is key. Plan for all scenarios. Build base, pessimistic, and optimistic outlooks to stay prepared. Tools. Platforms like TradingView, Morningstar, and Briefs Pro all offer energy and macro insights. Apps that alert on API/EIA inventory updates and daily production/refining reports. Read oil company quarterly reports to anticipate guidance and exploration plans. We've covered the fierce battle between OPEC and U.S. fracking and its influence on oil prices. This shock affects gas, food, inflation, and markets, and it hits your life directly. The risks are real. Companies that fail, governments may face budget cuts. But smart strategies exist. To protect and grow your wealth, diversification is key, whether with passive ETFs, DCA, or well-researched active plays. Remember, volatility can be a disciplined investor's best friend. Your financial freedom journey starts now. Click the link in the video description to unlock the ebook packed with investing secrets, mindset shifts, and wealth-building strategies.